All right. I guess I'll get started. My name's Elliott Holland. I am not an audit accountant, so I'm going to try to keep everybody up and have some fun with a topic that people think is boring, but I actually think it's probably one of the biggest pieces of ETA success. So I'm going to make this as interactive as possible, as fun as possible. The more questions that you guys have and the more stuff you're going to inject, the better I'll be able to perform. So let me start with the easy question. How many folks are pursuing a traditional search? How many folks are interested in a self-funded search? All right, excellent. So I touch on both here at the same time and explain sort of how what I'm talking about is different for each side. But I am a private equity professional who manages a team of accountants to do QOB. So my point of view is a bit different. So let me go ahead and get started. I'm actually HBS class 2011, section F. And let's get going. What you're going to learn today. So what is the ETA quality of earnings? Why are they unique? Why unreliable financials complicate everything? A better approach. And then we're going to try to end with some war stories and quality of earnings because we got to keep things light. And then what you'll know when we finish is sort of what jobs an ETA QOE must do. I hope they still teach that here at this illustrious school. A better rubric for choosing the right provider and common pitfalls to avoid. So this is me. Like I said, class 2011, section F. I worked in private equity. I worked in strategy consulting. Now I run a diligence firm. Why the heck should you listen to me? I get the bigger picture. So the conversations I have with my clients are not about EBITDA working capital only, but we actually advise folks on sort of how to make decisions based on the data, which is what most people sort of struggle with when they're not accountants. I've been doing this for 15 years. Before there was an ETA class here at HBS, dating myself to keep it around. And then we do 40 to 50 deals a year. So we're in market talking to people every single day, both non-funded and self-funded side. Here's a bunch of folks I've worked with. Just so you know I'm not lying, you may know some of the logos. I will share this around the folks, so if you know some people on the slide, you can holler at them and see if I'm any good. So what is the quality of earnings? No, really. Somebody help me out here. What is the quality of earnings?
I guess it's when you look to buy a business, you submit an LOI or an IOI or something, and you take whatever the seller told you kind of for granted. You've seen some sort of Excel spreadsheet and whatnot, but you get to a point where you actually want to understand if the numbers are what you think they are, or at least around that ballpark. So I mean, you need to consider hiring someone who has experience with this to figure out really how much the business makes in terms of revenue and profits and whatnot to make sure that you're buying the business that you think you're buying.
Excellent answer. Anybody want to add to that? Are there any standards for private company financials? Are people forced to report in GAAP, cash, accrual, toilet paper and crayon?
My understanding is, for tax reasons at least, it's typically done on a cash basis, but what they actually have in their internal system could be like whatever.
Whatever is probably the most accurate definition of private company financials. And who wants to overpay taxes? Raise your hand. I didn't think I'd see a bunch shoot up on that one. So you look at taxes, you should know they're going to be minimized from a net income perspective to minimize taxes. Also, the U.S. government and many other governments are incenting people to have programs that will minimize taxes like accelerated depreciation and other things. The other thing I talk about a lot is when people are getting paid 3 to 5 to 7 times EBITDA, how incented are they to tell a story? A lot of us tell stories for one-on-one stuff where you get $1 for a $1 lie. So you can imagine what somebody will do when they're getting 3 to 8 times. So quality of earnings, the way I describe it, is a mini audit that's meant for business buyers to actually take messy financials and state them in a presentation form that's cash flow based so you can make an investment decision. But everything you said was absolutely correct. And the cool thing about it is there's not like a strict definition. It's just a thing we all do before we buy a company. So the main pieces are EBITDA and add backs. I think equality of earnings is like terrible if you don't do at least a proof of cash, which is essentially recreating the income statement from the bank statements. Why is the proof of cash so important, folks? Does anybody know why recreating the financial statements from the bank statements is so important? Anyone?
Other financial statements are much easier to manipulate. It's like the income statement is much easier to manipulate, but it's much harder to manipulate cash flow statement.
We should talk. That's exactly what I said every time I'm asked. Yeah, so you can manipulate QuickBooks. People have probably done it. If you've ever been a strategic CFO or anything of that nature, you can absolutely manipulate taxes because nobody wants to overpay. But you can't go into JP Morgan with $100 and say, hey, tell Dean it's $1,000. You can't even go on there and like February 1st and say, hold on, I forgot. I really wanted this on January. Can you guys change that? So the bank statements provide conservatism and allows us to rebuild the financials from not an exact perspective, but a perspective that can allow you to understand what revenue was plus or minus, what costs were, and therefore profit. And then profit per product or service is important because as you get into these businesses that have multiple products or services, particularly run by kind of lifestyle business owners, you will often find that there are services, products, locations that aren't profitable. And whether that's because a strategic reason or a silly reason, you should know. And so broadly, when I talk about equality of earnings, these are the three things that are sort of top of mind for when we're going through stuff. Now, it's a lot more than that, but this is generally what it is. I'm talking to everybody, so I don't know if somebody just read Buy Then Build yesterday or some of you guys already bought companies. So I laid out the deal sort of timeline from deal sourcing to evaluating to due diligence to closing the transaction to growing the business, so you understand that we're in the middle. And so equality of earnings is something you should start probably within a couple of weeks of getting a deal under letter of intent. Why is that? Well, if you are a transaction accountant, you should probably kick the tires quite a bit before you pay anybody to kick the tires better than you. If you came out of marketing, operations, if accounting is as clear as Japanese to you, then just go get a quality of earnings provider right away. Most of us do phased work. What you don't want to do is put pressure on your deal timelines because you wanted to wait and look at some stuff and act like you're smarter than you actually are for 3 weeks to say you did it because it said that in the Harvard Business Guide to buy a small business or buy then build. Like, we talk about stocks, right? Are you the smart person or the dumb person in the room when you're buying? If you're the dumb person on accounting, go get some help. So why are QLDs for ETA different and unique? Well, here's the issue. How many folks worked on Wall Street in investment banking, PE, VC, or even like consulting? If that's you, all right. So when you're in those industries and you're doing deals, you have 2 to 5 people who are all experts at doing deals. You got 6 or 7 figure budgets to do diligence. You have budgets to do commercial, operational, and financial diligence. You have all these things at your disposal to make a single acquisition decision. But what happens when you're an ETA professional? How big is your budget? Anyone? If you're funded, but I saw 2/3 of the hands that went up for self-funded. So how big is your budget when you're self-funded? Right here in your back pocket, right? So every time you go spend 10 grand, 20 grand, 30 grand with somebody, you actually have to pay it out of your pocket. Oftentimes folks are by themselves or with one other person. More and more people are not deal experts. So it's not like you're sitting with 10 experts on your team that know how to do deals that have done a whole bunch. So you actually have to get this right with less information. So in my opinion, the ETA quality of earnings is more a tool to even the playing field for ETA professionals so they don't get hosed because there's so many more jobs to do that we all know on the private equity side that you just have to do on a more shoestring budget on the ETA side. So I talk about, I was going to speak to both traditional search and self-funded search today. And this may be dated, but we know traditional search looking for slightly bigger companies, more growth. You typically need to look across the whole nation, and that's kind of what the game is. For self-funded, slightly smaller deals, growth may not be as important. You can go wherever you want, but you don't have a budget. So this presentation is speaking to both groups. So let's talk about why unreliable financials complicate everything. So one of the biggest issues with quality of earnings on ETA deals is that you can't trust the inputs and the financials you start with. So you can't just run them through some program, run them through some AI technology, spend 10 minutes at them and think that you've done like the world's greatest gross margin analysis. You really can't trust anything when you start, and you really have to sort of locate what's right, what's wrong, what's malicious, what's not. So we all know garbage in, garbage out. So when I look at small business financials, I see all kinds of things that are screwed up. And what ends up happening with most of my clients, I would say 2/3, and probably even worse if you go to like searchfunder.com or something. People will call me with like 10 pages of analysis on like a posting from BizBuySell, or like 20 pages of analysis off of a CIM from some broker. And when we talk, I'm like, 40% of that is probably blatantly a lie, or that broker could not credibly say that to anybody who knew anything about that and be believable. So your 10 pages of analysis on top of garbage didn't do you a whole lot of value. Now, would I ever say underanalyze something? No. But it's like your friend who tells lies all the time, like creating a whole narrative about that, like fundamental lie doesn't really get you anywhere. You got to get to the truth first. So what am I talking about when I say garbage in? Well, a lot of these companies don't even list COGS, cost of goods sold. Everything is an operating expense. So when we think about gross margin analysis or operating expense analysis or splitting labor up, you really have no idea, particularly when you're looking at the listing pre-confidential information memorandum, but even after confidential information memorandum. And then heck, let's say you get the QuickBooks Online access. Do you know how to split out COGS from operating expenses? Nope. And then most of these controllers at some of these companies are friends from high school, are barely competent at what they do. And so even if you ask them the questions, they're going to tell you something. Is that the truth? No. And it might not even be malicious. So you actually have to get to the bottom of some of it. Inventory being expense. Have any of you guys been in due diligence on a live deal, either professionally or in an ETA space? Couple of folks. How many of you have done it on an ETA deal? I'll tell you that probably 60% of the deals that I work on have all an inventory expense, which means you can't trust cost of goods sold. There's going to be very choppy material spend throughout the year. And you're also not going to know what the inventory balance is. So you can think about all your analysis that you do on a company that involves inventory will be totally off based on that. Prepay is not captured correctly. And oftentimes what people are doing is they're hustling. So you get revenue that doesn't have an invoice, or cash revenue, or all these stories about how this revenue showed up without being connected to an invoice. You have to figure out, is that the truth or not? So here's what I would commit. In ETA deals, looking at the financials is not enough. You cannot separate the financials from the operations of the business. On a larger deal, you can, because the financials are a function of a top-class management team, a very competent controller, the Harris Williams-like investment bank. When you're dealing with business broker deals, you can't trust any of it. So you have to think about, do the operations of a Main Street business or a founder-led business, do they mimic the presentation of a top-level company with good financial stats? Probably not. And so what you end up doing is asking the question, here's what I see, here's what I believe. So like a 40% growth in a Yellow Pages business, 2022 to 2023. Like, come on. It doesn't make any sense, right? Lower cost of AI talent. Doesn't make sense. So some of the things you have to do in these businesses is just kind of gut check that, do these numbers make sense in the context of an operating business? So what I would say is I think there's a better approach. Now, I think that what people should do in their processes for evaluating these deals is look for the quality of earnings to begin the basis of your understanding of a solid financial set. Because we all speak in that language, right? That's the accounting business stuff that we speak. So you got to sort of get to a common language. But after you get there, you need to identify what key things drive EBITDA. What are the biggest revenue drivers? What are the biggest cost drivers? What are the biggest risks? Kind of get yourself seated in that mindset of what do I need to know? What do I need to be good at to win in this industry? And then you have to sort of take a look at what are the sustainability of these things? Because equality of earnings is looking at historical data. Is anybody buying historical cash flow? Nope. So we're using the historical stuff for a proxy for what's going forward, but everybody's trying to boost the most recent period to sell at a high multiple. So a lot of what's happening in the most previous period is a lot of inflated stuff. The brokers and bankers are really good at making it look great. Everybody's good at telling a story about it. So you have to sort of listen to what people say, let it go in one ear and out the other, and then think about, is this sustainable? And then now they've got this metric called SDE, which is my absolute favorite, which is seller's discretionary earnings, which is complete crap, really. But because there's so many people interested in these deals, people are paying the same EBITDA multiples. They were paying the same SDE multiples they were paying on a more conservative EBITDA multiple 5 or 10 years ago. And they're putting a lot more pressure on themselves. And there's no way to, in a fair market, say, hey, I really prefer EBITDA multiples, so can I price mine off of that at the same multiple? Nope. You either have to pay the price to get the asset or not. All right, so let's talk about revenue. To me, and you could probably describe this 20 different ways, right? But revenue is a function of salespeople and sales process, and then the quality of the service or the product, which means like who is actually selling. And is a seller ever going to tell you, hey, man, Dean, I'm selling everything, man. I got the salesperson. He's like an account manager. But like it's all my relationships from high school. So it's really me selling. So you have a risk here that I didn't tell you about. Nope. They're going to always tell you that somebody lower down in their organization is selling, that they have all the relationships. They'll have some spreadsheet. But how do you actually know it's them? And then how repeatable is the sales process? So in like e-commerce and some online businesses, you actually get better data through their dashboards, like return on ad spend. Amazon will give it to you. Digital marketing-led companies, you can get it. But like these home service companies that are so interesting to everyone, right? How do you know how repeatable they are? Or I'll ask a better question. You guys are probably looking at companies already because you're smart people. How many people say, oh, it's word of mouth? Oh, it's referrals. Oh, it's my website. And you go to their website and it looks like some WordPress stuff from 2002, right? And so you really have to dig into like, what is their real repeatable process? And is it more complicated at all than the owner who's been hustling for 30 years? And then the reality is whether you're a funded searcher and you're going to have to go through your investors to get this deal done, or self-funded, and you're going to kick the seller out and have to do it yourself if something goes wrong under a personal guarantee. Can you sell this stuff? Because if you can't sell it, the level of scrutiny you need to have around how is it sold is higher. If you can sell it, like I have some clients who are salespeople or are used to sales processes, and for them, it's not as big of a diligence issue. But the other side of revenue is like, how good is the product or service they're actually selling? Because a lot of times people say, well, like in software, oh, your churn's too high. Well, why is your churn too high? Oh, sales is bad. Oh, and what if it's just the product sucks? What if it's just the service sucks? And there's no way to like oversell a terrible product. And so when you think about revenue diligence, you have to think about more than just some QA provider told you the revenue is $5 million or $10 million. How did that build up? Who did the work? How good is the product or service? How is it priced relative to other products or services in the industry? All these things help you understand when you get in there and there's no help. Do you really think that you'll be able to sell as good as the person who was there before doing it? Costs are similar. So raw material or platform costs. Who are you getting raw materials from? Is it arm's length? transaction. I can't tell you how many times sellers have buddies from high school or relationships or situations where they're able to get better pricing than anybody in here would ever be able to get, that could hit your revenue hit your COGS 10%, your EBITDA 50%, right? Platform costs on the technology platform. So a lot of these technology platforms are raising prices. Are you right ahead of a technology price increase? Are there things that somebody, the owner or some marvel in the company are doing that really a technology would need to do under your ownership because you're not an expert? All these kind of things have to come to mind when you're thinking about COGS to live it. And then labor. So I told you a lot of people don't do cost of goods sold at all. So everything's operating expenses. But who's really got like a time tracking system on allocation of time dedicated to direct product or service time versus admin time versus vacation time on a $10 million transaction? Nobody. So you really have to think through when you're contemplating, oh, well, gross margin is great. Well, is gross margin even accurate? And that's not necessarily a malicious thing. That's not that somebody's trying to lie to you. It's just that private business owners have no reason to overinvest in accounting to make it easier for you guys to go buy these companies with perfect knowledge. And then operating expenses are no different. So overhead. Oftentimes on an overhead basis, we look at similar companies, either public ones or Ebis World or whatever, and say, okay, well, what's the overhead percentage of a company like this? But once again, similar to COGS, there's no telling what's in overhead or what's not. And you really got to be careful about the seller who's doing 3 jobs, or the habitual owner's partner, wife or husband, who doesn't really work in the business, but actually does everything in the business. And they want to just add them back, but they do have to work. And then efficiency. So could you be more efficient than the owner? Everybody wants to believe that. I hear it all the time. I'm going to add technology. I'll be more efficient. You should not think that this person has been working in this business for 20, 30 years, taking home everything that he could and spending it and spending money on BS. That should not be your opening position in how you think about these deals. If anything is inflated, you should wonder, is it just harder to do than I think? And some of that stuff you can't answer in a spreadsheet or on a Zoom call. You need to go sit with people, you need to go talk to folks, and you need to talk to industry experts. And so again, part of what I'm saying here is traditional quality of earnings are an accounting tool. The way I think about them as a deal professional is it has to extend to almost full diligence for an ETA arrangement, because you guys don't have $150,000 to get all these advisors to go help in all these different areas. And so you have to ask these questions. The other one that I laugh at is that probably 80% of the quality of earnings I see don't even convert EBITDA to free cash flow. Does a grocery store take EBITDA? You guys pay. When you order Amazon, I got my EBITDA card. No. Didn't think so. And so oftentimes just realizing that that's a key piece of the analysis that you either need to be able to do yourself or have your provider do on some of these $5,000, $10,000, box check quality of earnings. That stuff isn't in there, and it can screw you. Not just on asset heavy deals that make it obvious for everyone, but on deals with bad AR versus AP, right? Deals with bad debt expense, deals with just long work in process cycles. So construction's not the only business like that, but like home services are typically pretty quick. But like I've been working on some fencing companies recently, and they can actually have the same construction timelines to get paid. So they can actually put a fence up today and not get paid for 9 months. And so if you think about cash flow versus profit, they can be very different. All right, so who's out there doing this stuff? Oh.
This is a quick question on that. Do you have a suggestion if we're early on and before we're engaging the QOB provider? How can we as a searcher get a better feel for what cash is? Because I get a lot of like QuickBooks things and I have trouble trying to figure it out myself.
Sure.
The thing we can ask for from the seller that you think, because they don't have a free cash flow statement or a cash flow statement normally. At least the ones that I talk to said they don't.
No. D, you're my man. You hit me up the computer, and I asked a great question. Has anybody worked in a financial system like QuickBooks or Oracle or any of these financial systems? Have you ever been the one that input the data? Do you have businesses that you run that have a financial system? So here's the thing. It's funny, Dean. They all have cash flow statements. They just don't use them, so they don't want to share them. They don't understand them, so they don't want to share them. The broker doesn't understand them, so they don't want to share them. They couldn't explain them, so they don't want to share them. It's like I talk the story about all the time about the guy at the tow truck company. It's like, oh man, I don't have an asset list, man. I don't have a fixed asset list, man. We know the trucks that we have, no big deal. So I was asking him, so if I go in your yard and steal 2 of your trucks, you wouldn't know. Oh, no. Johnny would always know. He'd never let you steal the truck. Well, Johnny's got the list. Or he needs to sit down with me to get the list. And I'm trying to be funny to keep you guys up, but this is real SHIT, right? If you guys are putting personal guarantees, some of you search self-funded folks, right? I got a couple of friends that are going through bankruptcy right now because they made mistakes. If you are too academic to ask the hard question, right? But let me answer your question directly, Dean. It'll be hard to get a cash flow statement before you're in due diligence. So I'd actually argue that you need to put it as a thing that you need to get as soon as diligence starts, and in between LOI sign and you hire somebody like me, you get a cash flow statement. And you just say, hey, look, I don't know how you run QuickBooks and don't have one. Just give me access and I'll pull it. Right. And, you play stupid until they acquiesce. And even if the cash flow statement stinks, I've been in Oracle systems where the cash flow statement was terrible, you'll still have sort of operating cash flows, investing cash flows, financing cash flows, and you'll be able to sort of at least have another data viewpoint. You'll also know whether they're purposefully hiding data from you, which I think is an important thing to know. If every financial system in the world has a cash flow statement, then why is it hard to get yours? The other thing is just you need to know whether you're in a business where sort of EBITDA conversion to free cash flow is efficient or not. So of course we all know, like in the trucking business, doing like long-term trucking up and down the East Coast, huge amount of CapEx goes into those businesses. So you know that EBITDA and CapEx are totally different. But you might not know in the fencing company. You might not know in some other widget business that allows their customers to pay in 90 days, maybe because they're Fortune 100 companies. So if you think that there's a difference in between, here's how to say it. If accrual presentation of the business and cash presentation of the business would be different, or if you don't think EBITDA represents cash flow very well, that's when you need a cash flow statement more. And what you need to do is, even if you don't know it, because guys, I sat in your seat, I didn't know any of this stuff. And none of those finance classes that I took here, as great as they were, taught me as much as like getting yelled at by my bosses on not knowing this stuff, right? Just being real. Over time, you'll realize what you're good at, what you're not. If cash flow isn't something that you're good at, get better at it over time. Your 5th time looking at stuff will be way better than your first. Your 50th way better than your 5th. Is that fair? Yeah. Anything with assets associated with it, you need to be looking at it more than electronic businesses from that perspective. The issue with electronic businesses sometimes is that prepaids and that kind of stuff can screw up the difference in between EBITDA and cash flow. And a lot of people who are dumb as a fox will play games with that to have you lose a lot of money, not recognizing what the prepay should be. So there's a bunch of people that do this stuff. If you've been on Wall Street, you know all the folks on the left. The regional firms, you guys probably know Boulay, Hood and Strong, some of these folks. The price is different. What they do is different. The way that I say we're different is that I actually provide advisory services to my clients. So what most of my clients are asking me is sort of do the quality of earnings, but talk to me about, is this deal worth what you're paying for it? Now, I can't answer that in some report and put my name on it and sign it, right? But in the conversation we're having with people, that's the conversation that we're having. We also have advisory services, so we can actually talk through projection models and some of that other kind of stuff. If you guys are familiar with like a merchant banking model, we sort of are putting that together at Guardian. And so it just depends on what you want. Like if you're a financial genius, you should definitely go get like a regional firm, because the stuff that we do won't be all that additive to you. But if you're saying, hey man, I'm searching by myself and I really want to get this right, it's my first one, I have plenty of chances to take more risk on subsequent ones. Even having a thought partner, even if they don't add a whole lot to the conversation, will just help me sleep better at night. This is some way to kind of think about the different providers that are out there And that's why I think having a deal background, running a diligence firm is a competitive advantage for those that kind of see the difference. So that's my contact information. And funny enough, Twitter is my number one social. So I gave up on LinkedIn. So if you want to find me on social, go check out Twitter. And what I wanted to do with the rest of the time was go through some Q&A. And then if that runs out, I have a series of war stories that I've captured from my time doing deals and my time advising people, and some public ones that I've captured that are a lot more fun to talk about than accounting stuff. So I'm hoping you guys aren't going to be shy and ask some questions, because that's way more fun than me talking more.
Versus before, imagine that kind of thing, like financial past. Tell me where it was, not it.
Sure. And I think this goes to one of the challenges of ETA is that you're not Steve Schwarzman, you're not Warren Buffett. But in that deal to that seller, you're their retirement. So you can't be scared to ask for what you really need, because actually getting it piecemeal ruins your relationship with them over time. So I'll also say a lot of times, like, I can tell you what it's going to be today and be honest and close a deal, or I can tell you once a week and upset you. We'll blow the deal. We'll waste, 2 to 3 months of both of our time, and you'll never trust me because I wasn't honest with you. This whole thing is a trust walk to the end. When you get a bunch of money and I get a beautiful business, if that's not what we're talking about, then maybe I'm in the wrong deal. And I think for entrepreneurs, they speak that language of trust, of not being sort of short-minded on how you convey things, and most people will get over it. The other thing is, keep in mind, who pays the broker's fee? Anybody got an answer?
The seller, but we were.
That's right. So get the broker on the phone and say, hey, man, I think you're getting 5 to 10% of this. Don't you want to get it quicker? Do your job and get your fee. And when I was in these seats, I wasn't confident enough to say it that directly. I tell my clients, and they struggle with it too. Now, some of you guys are probably the most gangster negotiators I've ever seen in my life. But if not, feel comfortable saying something terse that's honest, because that's what they're actually doing. The alternative is going back to market, waiting 3 to 6 months, getting somebody else to ask the same question you asked, to then wait 3 to 6 more months to get their money. So you're the fish on the line, you got to play it. I mean, you got to walk into these deals every day like you're a big Brinks truck, even if you don't feel like one.
So I feel like I can imagine scenarios where you do the QOE, but still things come up later that were missed. What typically falls into cracks? And how often are you seeing that? That's a good question.
So I am not silly enough to think that the quality of earnings catches everything. I'm not going to sit in here and lie to you guys. What we try to do is catch everything that could be caught given the data that we get. I'll tell you some of the main things that fall through, and a lot of them you can mitigate, but not on Zoom or on your laptop. So how many people have read a confidential information memorandum where the seller is remote or works 10 hours in the business? How do you know? Is there a spreadsheet? No, seriously. I mean, it sounds facetious, but how do you know an owner's working 10 hours in a business and not 80?
But if you meet with them and sit with them, they seem like pretty chill. Like they're not getting called. No, not big chill people. Like they're not getting called all the time throughout their meeting. Like then their business is probably running itself to that they can like take a call from you. You just call them and they talk to you for an hour. There's right somewhat of an indication.
That's right. Let me push it. If I'm getting a $5 million check, how long would I send calls to voicemail to make you think I'm chill? No, this is the game.
Yeah.
People don't like it when I say it, but this is the game. I recommend people spend a day with the seller. Well, then how the heck am I doing that? The broker will hour. We go do a late breakfast, right? You keep talking. You have a bunch of talking points. Don't bring a clipboard. Keep talking. Hey, I want to see some sites. Okay, now we're going to 1, 2 o'clock. Hey, man, I'm hungry again. What's the watering hole around here? I'm going to live here. Where do people have, a libation or celebratory drink? Now all of a sudden you're 3 or 4 o'clock, and now you spent most of a whole day with the person. And if they're in the business, they're going to need to take phone calls, emails. I mean, shoot, we all worked before we came here, right? Can we spend a day without taking a phone call or an email? No. So the more that you extend the time that you spend with the owner, the more you'll be able to tell whether they're in the business for 10 hours or 80. And until you do that, you actually don't know. So I'll tell you, I'm working with a client on a post-close project that I call Guardian Grow. So after people close the deal, there's a lot of stuff to kind of get the deal set up and help grow the business. Well, he had a $250K SDE, called it truck services business. He was told that the owner worked 15 hours a week, was on vacation all the time. Ended up, the owner was actually working 24/7 on-call dispatch, was doing all the invoicing and all the customer relationships. So when he rehired for those 3 positions, SDE went to 0. So now he was going into his retirement to pay his SBA loan. And so I know everybody's going after millionaire status. I get it. But don't forget that there's $1 million risks on this too. And so you got to actually be prudent and smart. And some of these things you don't know. So the sales question was one that I push on people a lot too. Anybody have any idea on how you tell if the owner is the only salesperson? Or the main salesperson?
You speak to the clients.
Definitely a good way to do it. Any other ideas?
You have somebody else call or turn to a customer.
Secret shout. You should know what the sales process is of the company you're buying for yourself before you go through it. And that way you can always argue about the future, what you don't know. When you talk to the seller during the process or got an email from him or her, now you know, right? Now you can have a real discussion around who's selling, right? The other thing is a lot of sellers don't want you talking to the customers before the sale. Now that's a very reasonable thing. This is one of the tougher ones. But if there's customer concentration or you sniff something is off, you have to figure out some way to show up as an insurance agent, somebody who's making an equity investment in the company, a friend from college, something to go speak to those customers so you know. Because what happens is I'm the owner and I say, no, Cam's a salesperson. I hired him 2 years ago like my broker told me to do so I could sell the business to you for an inflated multiple. But you go to a meeting with Cam and Cam doesn't say anything to the client. Some of this stuff you can't fake because money is going to talk to money. So some of these things, it's almost counterintuitive, right? We like efficient and online. Some of the stuff you actually got to go hand-to-hand combat, spend time that you might not think you need that actually can save your behind.
I think you mentioned asset heavier businesses being getting more prone to differences between financials and reality.
Sure.
But just in general, are there any industries or even sub-industries you've noticed are either usually fairly accurate or maybe like on the other side, always?
Digital marketing, you can tell right away. If you spend 5 minutes in a digital marketing business, they should have, 80 to 90% annual retention. They should have similar customers paying similar amounts. You can tell by how much a customer pays per month, what service they have based on most people's websites. So you don't have to guess or interpolate that. Those are pretty clean. Software, same way, because the same sort of setup. So that's why like SaaS companies are easier, or like recurring revenue companies are easier, not just because we love the recurring revenue, but they're easier to track. Construction is terrible. Terrible. You guys know what progress billing is? Again. So on construction deals, you start the project, maybe you get 15, 25% of the money. Then depending on how tough your construction client is, you may get another 50% halfway through, but you never get 100% until they say the project is done. Well, you finished the project a week ago, but they have to go say it's done. Well, if I'm them, why would I? Because I got to pay you. And so progress payments are very difficult to finance. And so those are terrible companies in terms of the difference in between EBITDA and cash flow. Trucking, which I love the industry, don't get me wrong, but you should just throw EBITDA out of the freaking room. It's not even relevant because depending on their CapEx structure, it could be a company that you just can't afford to buy, right? Because if the CapEx is high, 20% EBITDA company could be doing 3% cash flow margins. And why would you ever buy a company with margins that low? But if you look at it somewhere that says 20% EBITDA, you'd be real excited, right? You might walk around some of your sections and be like, look at this, man, 20%, right? And it's really 3%, and the people who are in it would know. Sometimes some of the companies, even the home service companies that service commercial clients, have construction-like payment terms. So big building downtown Boston, I'm doing the fence, but nobody wants to pay me outside of the general contractor's payment schedule. So I might be subject to that. And so what ends up happening is like with no debt, if I built it from the 80s, cool. If you're putting a bunch of debt on it, you need cash flow, not so cool. Those are some examples.
The deals you look at, what percentage would you say you find something that kills the deal versus something that, leads to a renegotiation versus maybe not finding any?
What's your name? Brad. Great question. It's gotten worse. And we're all market people, so I'm going to tell you why. 2022, 20% of my deals were what I would call fraudulent, like maliciously fraudulent. 20%. So seller or broker or both walked in and said, hey, I've got $600,000 of EBITDA I'm trying to pass off as $1 million, and I'm hoping you're a sucker. That doubled last year to 40%. Now, I'm not the cheapest quality furniture provider out there, so I would imagine I get some of the tougher deals, right? So I'm admitting there's a skew. This year, it's a little bit worse. And think about this. There was no ETA class when I was here in 2011. There was no Cody Sanchez, no Alex Ramosi. Search Funder was some podunk thing on the side of the internet nobody went to. And so when you think about the demand for small businesses, right? You guys are all in here on 5:30 listening to my behind talk about accounting, right? How many other schools have the same programs now? So a huge demand. So if you are a broker that a decade ago would have said, I love to sell that, but that deal kind of stinks. What are you saying now? I'm going to find a sucker. As some people don't have the budgets, we talked about that earlier, to diligence properly. And although I understand that I wasn't born with a silver spoon in my mouth, you can't hop into like $1 million, fire out of a frying pan. So I would say somewhere between 20 and 40. So if you listen to, I'm more on the self-funded side than funded. So I listened to Heather Andressen, who used to work at Live Oak Bank, and now she has her own debt advisory firm, and other folks that have big data sets like I do. You'll see something from 20 to 40% are just kind of malicious, fictitious, not at all accurate. So 20 to 40, another 20 to 40 are when I would say like 15% off plus or minus, or you can still renegotiate and get a deal done. I would say the rest are, sorry, I'm screwing the numbers up. 50% are sort of true to form. Guy said $1 million is 990. I love those deals. They're easy to get through, easy to advise. Everybody's happy, good to go. So out of the remaining 50, about half are within that 15% off range when you can renegotiate, and the other 50, so 25, 25, 50, the last 25 are so fictitious and malicious, they'd send you straight to the 4 outs. And the problem is increasingly, they're getting better at telling stories. So like last year, somebody double counted depreciation and tried to convince me that their way of interpreting GAAP accounting was more accurate than all the GAAP accounting that we've ever learned in our lives, right? Now, it took 2 or 3 hours of filibustering, but like that was their story. Now what I'm getting is a lot of financial sets that are sort of internally inconsistent. Any systems folks in here, like engineers, like programmers, the kind of undertask system thing? Well, when a system is made to work in concert, and all of a sudden, like the general ledger doesn't match the trial balance, doesn't match the bank statements, doesn't match this. Or how about this, when you guys are modeling, The balance sheet doesn't balance. Are you done with the model? It's only $5, Professor. Come on, man. It's only $5. No, it could actually speak to the whole believability of the financial set. And so what's happening is people are running games where they're only showing up after they've done their magic of like, $50,000 issues. The balance sheet doesn't balance, or the general ledger doesn't match the trial balance, but it can be indicative of the whole financial set. So part of the reason I'm here is I represent like everyday folks. You know what I mean? This isn't like some money pile that can just go away and everybody's okay. So it's important to check this stuff. And I think the biggest thing is just making sure you're pushing hard enough to get the answers you need. And I saw you, and I saw you too.
For that 25 to 25 spot, just where it's like, maybe there's some off by 15% with some areas fraudulent. But usually, what does the next step supposed to come to as sound between us and the
Great question. What's your name? David. All right. So most of my clients are first-time buyers, particularly like on their own. I worked in private equity, but like my general partner was doing a negotiation. I wasn't as an analyst, right? When it's totally fictitious, it's typically the entrepreneur walking themselves off the ledge. Because they didn't get to 2 months of due diligence, right? They didn't get through 10, 20 LOIs written up. They didn't get to paying a diligence provider. They didn't get to, talking to the lenders without investing a lot of time and emotional energy in this deal being the one that they wanted, right? Their dream deal. So then when they get the definitive data that, hey, EBITDA's off 40%, and you're not negotiating yourself out of a 40% EBITDA drop. It's typically, as a first-time buyer, you do all the, what about an earnout? How can I structure it differently? Can I get a bigger seller note? And stuff that like sounds cool academically, I could write it on the board. You know what I mean? The equation would work. But like, why am I selling a company when I'm keeping 50% of it and I know the numbers are fictitious and all that's going to happen is you're not going to pay me the seller note and we're going to be arguing in court. So the actual reality of the situation is tough, right? Those are tough. I have a couple of clients right now, and frankly, David, it's very tough to deal with them. I was talking to one earlier. It's tough. And I'm giving you that so you know when it happens or if it happens, that you're not alone when you're sitting in that wall screaming at it. It's tough. When it's closer, 15%, there's a retrade. But retrades are more complicated than you think because I'll talk about my process at least. 85% of the major EBITDA issues we find in a week or two, but we don't have the definitive quality of earnings done. So I'll call you and say, hey, David, like, look, I think EBITDA is off about 15%. But I'm still working on getting the trial balances right. I don't have the bank statements. I'm missing a couple years' tax returns. So it may take me another 2 or 3 weeks. Well, Elliott, the broker's asked me, what's my new price? You don't have an answer yet. Well, they're pressing me. They're gonna kick me out of the process. They say that, but are they really going to go back to market, spend 3 to 6 months finding somebody else just like you who's going to find the same thing, to have the same conversation with them? And having seen so many of these, I can tell you that, but it'll be tougher for you. So what you have to do is you have to get the news that it's off 10, 15%. Tell the broker, hey, look, you presented $1 million. It's looking more like 800 to 850. I actually need to finish the work that I paid for to get a final number so I can actually tell you how to restructure it. I gave you the time and I believe what you said. Now you got to give me the time to figure out what my truth is so I can give you an answer. And if you got to kick me out now, I understand that, but I'm way closer to closing than anybody else. So those are the two general ways those conversations go. But they're tough on both ends because keep in mind, the sellers and the brokers are typically way older than us when we're going out here to fight. They've just seen more fights, they've taken more punches, they know more game. And so there's a million ways to push somebody. And then frankly, a lot of us are like, well, if I don't get this deal out of 6 months, I'm going back to McKinsey or Google, right? You're already talking to your contact. Like, hey man, can I still get in there? And so the brokers know that. And so some of the screws they're putting on you are cognizant of that pressure. And my older business partner, when I finally got started in self-funded deals, was like, sometimes you got to play poker without cards. You got to blow. You don't have the fortitude inside of you. You never earned it. You know what I mean? Like you haven't been through enough negotiations. but you got to act like you're Warren Buffett today. So how do you actually do it? So I'm going to start with some ways you may laugh at, but are better than nothing. So the Ebis World stuff on Search Funder is better than nothing, especially for small businesses, because you can't call your friends on Wall Street and get like some $1 billion analyst report on a HVAC company and think that that's relevant for your $10 million one in Phoenix. So the Ebis World stuff, although I could spend a whole day on why it's not great, it's better than nothing, and that's what you're looking for. The other thing is Search Funder is full of people, and so is Twitter, who have bought companies in certain industries, and they say it publicly. So if you're looking at HVAC, plenty of folks that have bought HVAC. If you're looking at fencing, plenty of people who bought that, and it's there. You have to spend more than 10 minutes, but it's there. People who are entrepreneurs will answer entrepreneurs about, hey, I'm about to bet my whole family's life on this HVAC business. I have these 3 specific questions. Here's a $100 Amazon gift card or whatever to get some of your time. People answer that. Not that, hey, I know you're busy, but maybe I could. None of that soft stuff, especially on LinkedIn. Direct, here's my question, here's what I'm willing to offer, here's what I'm betting. Get to the point. The other thing is, so there are industry organizations. So at PE, we used to go to some of them, right? Like whatever industry you were in, you would go to them. Now you have to pay your own fare to Vegas to go to that thing. So it's a bit tougher. That doesn't mean it's a silly investment. And now oftentimes those conferences are on online platforms too. You get the app with everybody's name, you get the presentations. And so whether you actually go fly out there and go personally or leverage the app to get the best data you can, that's something else. You also have your classmates. I mean, I've done work for 10 of my classmates from 2011. I've called 30 for help on stuff. So now that ETA has become more popular, whether it's your classmate from whatever year you're in or somebody like me or other people in the past 10 years that have done deals, whatever affinity group that you have that you can lean on it. But I would just say, if somebody has any compassion in their life and their heart, and they're like, I'm going to bet, and you say, I'm going to bet my whole life on this, which not completely accurate, but pretty close, people will answer that.
And yeah, I think for and the question I had more around working capital, and I know that's a big contention, if you will, with sellers, because every dollar that's in there is one less dollar that they see in their pocket. I'm just wondering if you had any like tips or best practice to how to deal with those conversations, and what are the typical like working capital tensions that you find in deals such as these?
Sure. Great question. So most owners don't know what working capital is. And I promise you, if you point into an article on Investopedia or one of your HBS notes, that's not going to help. What they think of working capital is stuff I sold that I haven't got paid for yet. And until they know that's what it is, you are in danger of them retrading on it. And I tell my clients that I hate to say it, but half the deals that I see with working capital very explicitly stated in letters of intent get reneged on because the seller didn't realize that's stuff I sold that I didn't get paid for yet. And so the first thing is make sure you get enough balance sheets to write a working capital number in the letter of intent, because the number is different. So I'm paying you $3 million and I need $450K of working capital in addition to it. Way more likely if they address that issue then and you negotiate and maybe you get 300 than if you just say a reasonable amount of working capital in your letter of intent because it's easier to get it signed and now you're arguing 60 days later. Second off is if you explain it in terms that your audience can understand. I'm gonna give you a quick anecdote because I'm not trying to put anybody to sleep. I asked for some feedback through my email listserv about 2 years ago. Another HBS dude, a couple years behind me, was like, "Hey, Elliott, I love what you do, man, but sometimes you speak informally and it throws me off. If you spoke more formally, I'd be able to actually take your suggestions more easily." And I said, "How is that formal language going with the sellers and the brokers on your ETA search?" And I got to admit, he was a human. He said, "You know what, Elliott, not all that great." And so the reason I say that is because we can forget that some of the ways that we talk in these halls just makes you look stupid in those halls. And here's the other thing. Nobody's going to tell you, hey, Dean, you just spoke over my head, man. Can you dumb it down? And so when you're in these meetings with folks, you got to understand if you don't speak to their level of understanding, you will break the communication pattern. You will make yourself look academically smart and sort of operationally silly. You will make it harder for future communication. So what do I mean by working capital? You should say, hey, look, I can't buy a car with no gas and drive it. I can't buy your business for $3 million to get a loan and then need another loan for $500,000 to get the thing going. You wouldn't sell this to your kid without the working capital to run it. How can you sell it to me? Make it more human. Because if it's all about the numbers, most owners just are like, go get your own working capital loan. And they know that's out there. And that may have to be the solution. But I've seen way more successful negotiations where it's like, I can't go get a $3 million loan and then go get $500,000 more. I definitely can if I tell everybody all I needed was $3 million and now I'm wrong 30 minutes out of the door. And in fact, the only way I truly bankrupt this and fail and have to fire all your employees is to run out of cash. Not a bad month, not a bad year. The minute I run out of cash, I'm done. And so if you're telling me I should put myself in the poorhouse because you don't want to give $500,000 worth of working capital, I get that, but I'm not going to do that. So the more you're able to make it personal and make it layman's terms, the better off you'll be. And if you don't understand it in layman's terms, work on it. Like that's got to be, because working capital is so big in these deals, you got to get good at explaining it without current assets, current liabilities.
So building off this question on working capital, so do you, for your point to that, do you suggest like putting a number? Like,
Oh, absolutely.
but I'm worried about that because like, what if like there's the balance sheet isn't clean, and maybe there's some adjustments to EBITDA and that impacts working capital. That's why I've always been reluctant to say anything.
I know. I totally get it. What's your name?
I'm Jacob.
Jacob. No, it's all good, man. So I'm an engineer undergrad. So I used to like exact things a whole lot. Ain't no such thing in this world, right? Particularly in small business. So what you're trying to do is you're trying to say, what is better? Putting no number, putting a normal level of working capital statement that nobody understands, or giving your best guess at an actual number, and then recognizing that everything in your LOI and everything in your diligence is subject to better data that you'll get going forward. So my recommendation is always to put a number based on your last 2 annual balance sheets, right? Because you're not going to get monthlies more than likely. I took the average of current assets minus current liabilities, and it was $500,000. So my LOI is based on $3 million, $500,000 of working capital based on this calculation. This is my expectation. This is a deal I can close. Now, if you get through diligence and it's $650 or $350, you can change. The other thing that happens, folks, is, and I think this actually happens more on smaller deals than big ones. You start day one with a $3 million business. I'm just picking a number. Based on all the risk you see with the confidential information memorandum, was probably plus or minus 30%. A bunch of financials you don't believe. This guy, Elliott at HBS, said don't believe him, and 20 to 40% are fraudulent, right? But through 90 days of diligence, you trust the seller more, you trust the financials more, even though they're not GAAP. You actually understand what they are better. You get to know the business better. You go visit the area. And so sometimes you may say, hey, look, it was $3 million because I had $300,000 of uncertainty and I wanted $500,000 of working capital. Now I beat that $300,000 of risk out of it through all this other stuff. Now the seller wants to retrade and only give me $200,000 of working capital, which happens in my deals all the time. It's just the nature of the current market. And you may take that deal. You're not going to just roll over. You're going to hit ha. But you may take that deal because during diligence, you beat $300,000 of risk out of the acquisition. Because nobody knows at the SIM level, at the LOI level, if the deal's any good. At the end, I had an accountant that I worked for. Like he did, not transaction accounting, but like regular bookkeeping accounting. So smart accounting dude. We went through a very messy financial analysis. probably 6 or 7 weeks. Hard to get data. 3 or 4. If you ever see a deal with 3 or 4 brokers, know it's going to be 3 or 4 times the headache. Had 3 or 4 brokers on it. We finally got through, and he was able to acquiesce on a lot of stuff that a pure financial person wouldn't, because we would be risk out to do. I get you next.
To follow on Brad's question, so you broke it out like typically half are good, quarter so, quarter fraudulent. Yeah. If a broker is or isn't involved, do you see that changing? Like if a broker is involved, is it likely to be better or worse?
My engineering brain says that data point would not help me determine the difference in that breakdown at all. The reason being is the variability of brokers goes from the Mother Teresa of brokers, a few, to like normal brokers that just aren't CPAs, guys. You can't expect somebody to do a quality of earnings with a high school math knowledge, right? You shouldn't expect them to be great at that. They did the best they could. And then there's some completely fictitious ones, right? And so depending on who you get, depending on the seller, kind of gives you the spectrum of like crazy town to something more believable. What I would say is people poo-poo on brokers all the time. Unsophisticated, just like sellers. And I think that's one of the most silly things to say in the ETA world. Here's why. How many of you guys are trying a proprietary search, or one of your close friends is trying? How much fun are you having? Anybody want to speak about their favorite day on a proprietary search? The reason I'm asking that is the broker does a very difficult job, which is going and finding the seller so you don't have to. The broker does a very difficult job in explaining how nasty the due diligence process can be so you don't have to. The broker does a very difficult job of putting together all these materials based on really wonky stuff and making it look formulaic sometimes with just 2 pages and a tax return. I've seen those too. And so I think when we carry the perspective that the broker is unsophisticated, terrible, lies, we negate our ability to get the benefit out of the broker, which they can tell things to their client, the seller, that you can't. I had to call 2 clients this week and say, hey, you need to go tell the broker to earn their commission this week. Right? Because you can't tell the seller that, because you got to build a relationship with them. You haven't earned that trust. If they take your terse comment today and want to screw you the day after you buy, you have risk, right? Also, the broker can tell you if some wild out of left field thing that you want to do could potentially work. And so I would say that as much as we all understand how much the brokers can cause strife in these deals, make sure that you get the benefit that they provide too. Now, I answered a slightly different question, but that's how I truly feel. Now, where's the yet?
Yeah, could you talk about how you phase the work and what we can give you on like day one that would make that better?
Right. So generally, the quicker I get QuickBooks backup or QuickBooks online access and bank statements in CSV format, which typically sellers can just email their bankers for, I can get started. Now, I won't tell the seller that, but I'll tell you, my client, that, because I want them to think all 40 items on my list is important. We phase our work by, we'll give you a draft workbook within the first 2 weeks. Sometimes we get it in one, but I can't promise it, again, because of the data. Within the first 2 weeks, we'll get you a draft data book. We catch about 85% of deal breakers in that first data book. So it's effectively the phase 1. So if it's really bad, we typically catch it then, you kill the deal then, and we